Welcome back, everybody. This is Edwin, the Magic Engineer, and I wanted to have a quick video talking about a subject that I was actually talking to Rudy a little while ago on the phone, and I pitched this as an idea that I thought he should actually do on his channel, but he's been too busy and he's been doing other stuff. And so I called him or texted him again just a little bit ago and said, hey, can I go over that topic? And he was like, yeah, Edwin, go for it. So here it is. The topic I want to talk about is why price is more complicated than you think. And this is going to be kind of a financial video, but it's going to be explained through the perspective of Magic card players. And but the concepts that I'm going to be going over really actually do apply to like the bigger concept of like, you know, stock market and things like that. But the vehicle that I'm actually using is going to be Magic the Gathering to get these concepts across. And the reason why I'm saying why price is more complicated than you think, obviously there's a lot of people out there that already understand this stuff. There's a lot of finance guys, there's a lot of very well-educated Magic players. I'm not so much talking to them. Who I'm talking to and who I'm targeting with this video is there's an awful lot of people I've ran into that when I'm having discussions about like prices and I'm talking about, you know, where prices either should be or what's supporting prices, and I'm using terms like priced into the market and price discovery, people don't really know what I'm referring to. And there's just there is in fact an awful lot of Magic card players and investors and stuff that haven't gone over these topics. So I know there's a need out there, so I just figured I would cover it. So the first one that I want to go over is price discovery. And the reason why price discovery is a really important concept is there's a concept in free market trading that basically says when you have a bunch of buyers and you have a bunch of sellers and everyone's going to try to like meet in the middle, and at some point, you know, there will be an agreed upon price, right? And the analogy that's constantly used is like, say there's sellers that are all existing in the market and they're all driving prices down because the more people that are actually selling, the more supply there actually is, and therefore like buyers don't have to pay a lot. So a plethora of sellers is driving prices down. And when you have a plethora of buyers, that's effectively a pressure that's like pushing up on the prices, because there's a ton of demand and there isn't a lot of inventory, prices are going to have to rise. So you have these two forces that are constantly pushing against each other. And as these things kind of ebb and flow and push against each other, at some point you land on what is somewhere about a price. And what will happen for a lot of websites and a lot of like, you know, statistical information, stock trading kind of applications, they'll look at where a lot of like the recent sells have actually gone, and they'll pick a number and they'll kind of give you, you know, some number what they think that actually that price is working out about in the open market. And then once you have tools that are basically saying where that price actually is, then what you tend to see is a lot more convergence of prices. Like these anomalies that happen that are way above and below don't happen nearly as much once there's like a feedback loop and prices are now being actually like shown to others. But this whole process of going through all of this is what's called price discovery. The important reason to understand this term, price discovery, is because it's something that doesn't happen when you have external forces that come into a market and like shove it one direction or another. Like a central bank changing an interest rate, or when you have like if it's a trading card game and you have the company coming in and constantly printing new cards into the market. I mean, you don't really know if that price discovery is going to really be found because you have this external force that's constantly going in and shoving that around. But the concept needs to be understood because it is a real thing. It does exist. This is kind of what free market capitalism is all based around, right? This is where like all these benefits of capitalism all kind of come out, is in this price discovery mechanism. So the next topic that I want to go over, and like of course many of you probably are already familiar with that, but the next phase of it might be a little bit more complicated. The next topic I want to go over is when something is called priced into the market. And I'll briefly discuss it here, but then I'm going to switch camera views and I'm going to go to an overhead view where I'll show you a little bit more of like a pictorial example of it, but I'll quickly describe it. When something's priced in, what that basically means is you have a lot of things that could be pressures pushing up on prices or down on prices. And let's say a bunch of people that are all buyers and sellers, they hear about something that's going to happen. And everyone gets really worried about how that's going to affect it. And maybe one of these arrows just gets to be a little bit smaller, right? Maybe there's the force of the buyers is a little bit less. And since the force of the buyers is a little bit less, that means the price is going to start coming down until there's a low enough price to get buyers attracted to actually come in there again, right? So if people hear about something that's going to change and that decreases the number of buyers, then what eventually happens is this line that used to be here kind of starts moving down a little bit, right? And then at some point, the decreased effect of the less buyers gets finally priced into the market, and then you end up with a new value of whatever that price actually was. That's called being priced in. And that needs to be understood because I constantly hear players mentioning things like, oh, well, there was this change, with a card being printed, or, there's a stock and, the company is now going this direction. It's all going to zero. And that's like ignoring the effect of these other two and just completely looking at that one. So let me give you a bit more of a graphical pictorial example now of priced in. Okay, so what we've got is a little bit of an example here to try to show the dynamics between inventory, buyers and sellers, people holding, how that really affects prices. And so what we've got up here is we've got the dark blue is a person, the light blue is just some asset that the people are actually holding that they might want to buy or sell or whatever. So here you kind of have the market where there's active buying and selling actually happening. Right here you got people that actually own the asset, but they're not actually doing any active trading. And over here you got a bunch of people that don't own any of the asset, but they could actually become buyers later on. So I wanted to set this up because I want to make it clear that here in the market, these guys are all actively trying to sell. And they have this asset and they want to get rid of it. And if we start changing things by like giving like these sellers lots more assets that they're trying to sell, what you're going to see is that market price gets like shoved down now because there's so much supply up here and there's only like a couple of buyers, right? And right now the buyers, like maybe these guys have just actually purchased something, so they might actually leave that area and go over to the holders section, right? And then these sellers would be sitting there waiting for people who are not involved to now come in, and then now these guys are each going to be competing with each other, trying to like sell that asset, right? And there's a lot of things that can affect like this little market and this kind of dynamic, but what I want to make clear, though, is that when people are trying to actively sell, this is where that price is getting worked out, right? Like if this was like a stock market trading floor, this here would be the actual stock trading floor. This would be people that are sitting at home, looking at their 401k bank balance sheet, and they own a bunch of stocks and things like that, but they're not actively trading it at the moment. And these are guys that don't have like a 401k at all. So in like a typical stock environment, what it's actually closer to being is something that's kind of more like this. Like maybe not necessarily anyone is actually out there buying or selling anything of that actual asset, right? And a worst case scenario that you really don't want to happen is you don't want to have a situation where you got like a bunch of sellers in here and they're all trying to sell that asset, but there's only like one buyer, or only like a couple buyers actually show up. That's not very good at all. What you also don't want to have is a ton of buyers, but like no sellers, because like nobody actually wants to get rid of that asset. So this is the kind of situation where prices are just going to go through the roof, right? Where a lot of people want to buy, but nobody's selling. And then the other situation is where there's going to be a bunch of people who are wanting to sell, but like nobody's wanting to buy. This situation is a stock market crash. This is where prices are just tanking like crazy, right? This situation is basically what happens in like a big like bubbled economy where like prices are just shooting up to the moon, and all these buyers came running in because they saw a bunch of other people make a bunch of money. So like, you know, Bitcoin just did this a little bit ago. Bunch of buyers came in, not a lot of people were selling, and that price just spiked like really high. So this is a really important dynamic to get this whole thing down, and hopefully this is making sense so far. So now let's make it a little bit more complicated. Okay, so now we've got this same setup, but as you see, I've made this a little bit more complicated. Now I've basically described that we've got sellers, and these sellers have these reasons why they want to sell. Now we've got buyers over here, and these buyers have these individual reasons that they actually want to buy. Now, the reason why I set this up is because I wanted to break out the fact that everyone's got like all their own reasons on why they want to buy or sell like any asset, and this is where the priced in piece comes into play, right? Now, as you can see, these sellers, maybe this guy here, he just actually needs to raise money. Maybe he needs money for just something else entirely. Who knows? Maybe he needs heart surgery. Poor guy. And this guy, he wants to sell his asset because he's bearish. That basically means he thinks this thing is going to go down in value. This guy, perhaps he wants to sell his asset because he just wants to go into other investments. You know, whatever this thing is, he's got something else he's more interested in that he wants to put his money into. Now, for the buyers, very similar to the sellers, this guy needed money. This guy actually has money to invest. So he wants to buy it for exactly the opposite reason. This guy actually thinks that asset is going to go up in value. He thought it was going to go down. He thought it was going to go up. One of them is actually correct, right? So, you know, who knows what that's going to be. And this doesn't always exist for like stocks. It can, but maybe this guy just wants to buy that asset because he loves it. In the case of like Magic the Gathering cards, maybe the guy wants to buy cards just because he loves those actual cards. In the terms of like a stock, maybe there's somebody who just believes in that company and wants to buy that company because they love it or something like that. You know, that can happen. The point is that everyone has their own reasons why they need to do any of these things. Now, let's take a typical example of what might actually happen. Let's say an economy goes into deflation. And when the economy goes into deflation, a lot more people need money. So maybe some of these holders, they come over to this need money category, right? And they show up over here. And now you got a lot more selling pressure than what you actually have buying pressure, and these sellers overwhelm these buyers. And so that price that used to be like right here in the middle, now it starts going down a little bit and down a little bit more. And at some point, that price has gone down to a point where everyone seems to be happy with it, and I'll erase these top ones. And this is now the new price. Well, that's called being priced in. Now notice that this didn't change. These ones didn't change at all. There's still this guy here who's bullish. There's still this guy who just loves the asset. There's this guy who still thinks it's bearish, and this guy who thinks there's other assets he wants to invest in. They're all still there, but what basically happened is one of these factors changed. It piled up a bunch of people right here, and that ended up shoving their overall price down. Now, so as the impact of this one thing got priced into the market eventually leveled out at some new price, and then everybody, you know, began their trading again. That's a really important thing to understand, because many people, when I see on forums and such, and they're talking about, oh, well, if reserved list cards, you know, get reprinted, then all the values are going to tank. And what I want people to clearly understand is that's one of these categories. That's not all of the categories. So there can still be people that want to buy those cards for other reason. And another thing to keep in mind is don't imagine that these guys didn't have an effect on this. If everybody was looking at the market previously and it was like this, and then all of a sudden all these other sellers came running in, well, this guy is probably, he already was bearish. He's going to now get more bearish. This guy was bullish. Maybe he's now going to suddenly go over here and join the bearish side, right? Because he sees this happening. So one of these doesn't have a direct effect on the other reasons to buy or sell right off the bat, But then after some amount of time, there is an impact that one of these can have on all the others. But all that works itself out because you have this buyers and sellers all coming into the middle, and that price eventually gets worked out, and that becomes the new price of that asset, and that's the price discovery thing. Okay, for this next section, what I gotta go over is reserve list cards, and there's a bunch of them up here, and this is all part of the game Magic the Gathering, and the important thing to understand for those who aren't familiar with it is there's a bunch of cards that were made like 25 years ago. These are some of them right here that are never going to be made again, and there's like a legal contract by the company who made them that said they're never going to print them again, so they're a very limited supply. And there's been debates with people that play the game Magic the Gathering on whether or not they're ever going to print these cards again. And so every time that debate comes up, there's a little bit of an impact on the actual prices of these actual cards. And so that should kind of frame the example that I'm about to give in just a second. Okay, so I just described how the reserve list cards, what they are, and how they're an important asset that's actually traded and of the details about them. Here's how the reserve list could affect something like this. Now, as time goes on, more and more people play Magic the Gathering, and so you get more and more players coming into this market all the time. And so it's kind of like more people are showing up in these categories constantly, and that's driving prices up. Like every few months, another person adds into here, and those prices, they were at one level, right? And then all those people came in, and that level just kept rising, and now it's like the price is pretty high. Now, people say, like I know Daniel Chang has said, if reserve list cards ever get printed again, then what's going to happen is that's going to bring these prices way down, and then eventually they'll work their way back up again, right? And so they will recover. And I don't disagree with that. Sorry, my cat's trying to walk on the board here. I don't disagree that prices will come back up. But here's the thing that people are missing. When you start with this situation where there was only like a couple people, and that price started going up because more and more buyers were entering the market every single year, that price was ratcheting up. If something knocked that down, like a bunch of reprints adding a lot more supply into the mix, a bunch more supply came in, and that price got knocked down a good amount. Well, if people keep coming into the game, then the price will continue going back up, and it will eventually hit that same spot that it was actually at before. And that's basically what Daniel Chang is saying in one of his videos, where he's saying even if they reprint the reserve list cards, the price will eventually recover. But here's the point that I think everyone's missing. The quantity of cards was priced into the market. When it was something closer to this line should have been way up here. But now, since there's more quantity in the market, like this, because they printed a bunch more, that line ended up being back kind of where it was. So the answer to this dilemma that I'm describing is yes, it will actually affect the prices and drive them down if reserve list cards do get printed. Yes, they will eventually go back to where they would have been before. But the thing that's different about it is the price would have been up here, but now the price is only like it went down and then eventually recovered to back where it was instead of going much higher. Looking at it on a chart, it's kind of like that price was kind of going up over time, and then they all got reprinted, and then it eventually recovered back to that same point that it actually was before. But what I'm saying is, if that reprint had never happened, then it would have been up here. That price would have been up here. But the reprint caused a drop in prices, and then the eventual continual growth brought it back up to where it actually was. So we have a price recovery, and that's what the point he's making is of reserve list cards. But that price would have been much higher. And this difference here is because the quantity of cards, this happening there, priced into the market and set a certain price. And that's a concept I want to make sure that people clearly understand. Okay, now this last concept I want to go over is leverage and inflation. And this is an important one to talk about because everyone talks about the federal funds rate, you know, the Fed's interest rate, and wonders why that actually has an impact on the prices that everybody actually sees for assets, whether it's a house or stocks or Magic the Gathering cards. All of these things are affected by inflation, and by inflation directly affects leverage, and I'll explain that here in a second. So let's say you have $100,000, right? And you're going to buy some asset, whatever it is. If you actually have that cash, then you actually don't care about this thing called leverage, because leverage basically means borrowing. And when you borrow at interest. But in this case, there's no borrowing. You actually just have that money. But inflation, we're going to use easy numbers. Let's say inflation is 2%, right? Well, in 1 year's time, this 100 grand will buy the same amount of things it'll take $102,000 to actually buy the same amount of stuff that you could have bought with $100,000 like the previous year, right? Because this number, like, it basically lost its purchasing power by like 2%. That's what that inflation actually was. A way to think of it is like your investment, oh, that's a terrible pin, let's go to the other side. Your investment is basically like a bathtub, and the bathtub is filled with water. And the water in this case is basically your investment. But, you know, there's a problem actually. That bathtub has a hole and that water is draining out, right? And so you want to actually do something with that investment. You want to get rid of it before all that water drains out, because that inflation is killing you. You know, you're losing 2% of your water like constantly, and you got to do something about that. So that's a pressure that's actually put on things. But that's if you actually had all the money. Usually what happens when people are doing investing is they don't actually have all the money they're going to invest. They borrow money and then they go invest it. Well, you already have that inflation that's like one size of drain. What happens when you go on leverage? That drain now, the wrong side again. That drain is much bigger, and the rate that water is flowing out of that bathtub is much greater. Because let's say you borrow the money at 4% interest, you owe a bank 4% every single year, but then you also lose value due to inflation. And so you can think of it like, you know, you get this big chunk of money, but you gotta beat that rate. Let's say, in this case, the inflation was 2%, the money you borrowed was at 4%, so if you can't beat 6% on whatever it is you're going to invest in, you're not going to actually make any money. You're going to want to at least try to find something that's like 9%, because this is, if you make 6%, you're breaking even. You haven't actually invested in anything good. So you actually have to make something that's a few percentage points higher, like 9%, to actually make something. And now you can kind of start to see that there's a problem. It's kind of like two things kind of racing each other. You know, the inflation and the interest from the leverage is like, it's like constantly chasing you. It's like it's always ready to like eat your money. And you got to find something that's better than that rate, or you're not actually going anywhere. And this is, by the way, one of the reasons why like so many, you know, gold bugs and other people you hear about want to go back to like having 0% inflation. Because then you don't have to actually go borrow money. You could just sit on money and be perfectly okay. There is no more drain anymore if there is no more inflation or deflation. You can just, as long as you can beat 0, you can actually do good. But anyways, now where's that eraser? Oh, there it is. So now here's the problem that you basically have. So you had that person that had the 100K that they wanted to invest, right? They borrowed this money, and they went out and they bought, like, say, in this case, a whole bunch of Magic card boxes, right? Well, if now they know that they're draining at 6% a year for inflation and also the leverage on that loan, if that person who doesn't think that they're actually going to beat that % interest rate, then they've got a problem and they actually need to get rid of it. In fact, if the Fed raises interest rates, then the rate of inflation goes up, and that will directly affect this. If inflation now goes to 4%, right, then this is actually going to go to 8%. So now they've actually got to beat 8% of that money to actually do something with it, right? Now let's say the person had invested in something. So previously this was at 2, and so this was 6, and the person invested in something that was gaining them 9%, right? So they were getting a 3% gain, and they were happy with it because they bought all this magic cards and they were selling it into the market and making that 3% spread. They were really happy with it. But then the Fed raises rates, and let's say the Fed goes to a more normal rate of like 5% federal funds rate, right? So inflation in the economy hits 5%. This was 6. Now this is basically 9. And so that investor is looking at it like, you know, I've borrowed all this money and I'm going through all this work and I'm getting eaten up by inflation and leverage at 9%, and I'm only making 9%, so I'm effectively not really gaining any money. And so what that person is going to do is they're going to get rid of that asset, because that 100 grand now is what they would call dead money, right? And this is the important part, because when inflation kicks up and when interest rates start going up, then people that are sitting on all these assets, and that includes houses, that includes real estate, that includes anything that people borrowed money to actually go invest, they're going to want to all sell that stuff into the market. And when everyone comes in and sells, prices all start to go down. They're going to want to get rid of that asset, right? Get that thing off their books and just get a bunch of cash in hand and be ready to find something else. They're going to look around for something else that they hope makes like 11%. Oh, this pin, the wrong side all the time. That they hope makes 11% or maybe 12%, so they can actually have a spread again, right? So that's the kind of effect that you're going to see when interest rates go up. Everybody starts selling everything, and the more money that people borrow, the more they're going to need to sell. And the reason why this affects Magic the Gathering and reserve list and everything is there's an awful lot of people that have borrowed the money that they actually invested in all this stuff, and so they're going to have to get rid of all of it. So that's what I wanted to go over. I hope that made some sense to you guys. I hope these examples actually came across pretty well. Thanks for cruising through the channel. If you guys want to leave some comments below and give me some feedback and maybe your own experiences, love to hear it, and maybe straighten me out on a couple things that maybe I might have gotten wrong. So anyways, thanks a lot, everybody. See you later.